Today, I'm going to debunk 3 common dividend investing myths. These are statements people will often say online as though they are fact. My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoy the video. I've been sharing my personal dividend portfolio on YouTube for over 5 years, and I have learned a ton along the way. There is always more to learn, but so far I have a pretty good total return at $78,000. The account generates $4,600 of annual dividend income, and my dividend payouts continue to grow over the long term. However, I hear a lot of things I would consider to be dividend myths. First off, that high dividend yields are value traps. I'm sure you have heard this many times online, and newsflash, that is not always true. It sometimes can be true, which I'll explain, but there are many cases where it is not. So you cannot use that as some just baseline heuristic. I have 2 examples in my personal dividend growth stock portfolio that completely bust this myth. That's the Altria Group, ticker symbol MO, and ExxonMobil, ticker symbol XOM. In late 2023, early 2024, Altria Group was trading at a 10% dividend yield. Many people see high yields like that and they think it's too good to be true. They think it means that it's a declining company with poor fundamentals and that dividend may even be at risk of being cut. However, you have to look deeper. If a company has stable and growing earnings with stable and growing free cash flow, then that high dividend yield may have actually been a buying opportunity. For example, the Altria Group has a sustainable and growing dividend payment. The 5-year compound annual growth rate of the dividend is 4%. And the payout ratio based on free cash flow is sustainable at just below 80%. Now that is on the higher range, but that is by design. Altria is a very mature company that pays out the overwhelming majority of their cash flows as dividends. So if we go back to my portfolio, I used that as a buying opportunity and I built up my Altria position with a 9.51% starting dividend yield on cost. And from reinvesting dividends, I've earned over 95 shares, which makes my dividend yield on an initial cost basis 11.45%. This company pays me $2,280 of annual dividends, and I now have a total return of $12,300 or 62%. So no, high dividend yields are not always value traps. If we take a look at ExxonMobil, ticker symbol XOM, I had a 9.68% dividend yield on cost. From reinvesting dividends, that's up to 11.77%. In 2020, during the oil crash, ExxonMobil had a ridiculous starting dividend yield. And at the time, people were saying that ExxonMobil was a value trap. I know because I was making videos about how I was buying the stock. And to be fair to their point of view, they were losing money at that time because the price of oil had become deeply unprofitable. But I knew that ExxonMobil had a reliable dividend payment that they increase every single year, even through prior bad oil markets. I knew that they were responsible in not growing too fast in the boom times and that they had a strong balance sheet to be able to survive that period. I also knew from analyzing the company and that economic environment that period of losses was going to be short-lived. Over the following years, oil boomed to highly profitable levels and still is at a very profitable range. And that has resulted in a great return in terms of stock price for ExxonMobil, and I locked in a great dividend yield on cost. That company still pays me $664 in annual dividend income. And from reinvesting dividends since 2020, that's given me 29.7 shares of the company. Overall, my return on ExxonMobil stock is 223%. That's another $12,000 gain. So again, high dividend yields are not always value traps. Dividend yield alone actually tells you very little about the financial picture of a business. All that tells you is what the dividend payment is and what the current stock price is. And newsflash, the market is not always right. The dividend yield for ExxonMobil was very high because the stock price was low relative to the dividend payment. But you cannot look at those variables in isolation. You have to look at it in the full financial picture of the underlying business. For Altria, you saw a low stock price, but if you looked at their earnings and their free cash flow per share, you would know that they could still afford their dividend payment. So every once in a while, you need to look for those opportunities to nab a high quality stock with a high dividend yield on cost. Myth number 2 is that dividends are only for retirees. Said another way, dividends are only for old people. If you can't tell, I am not that old myself, and I would argue that is anything but true, especially if you follow a dividend growth strategy like me. All a dividend means is that a company is paying a portion of their profits out to you as a shareholder. Some of these companies pay a lower yield based on their stock price. And of those, some high quality companies will raise their dividend consistently at a very high rate. For example, like Visa, which is a core position in my portfolio. And then you have higher yield examples like Altria and ExxonMobil, which I mentioned earlier. And from owning these stocks, I not only get the capital appreciation that can happen as they grow over time, but I get the consistent, reliable, and growing dividend payments. For example, this January, I got paid $626 in dividends. But the real power of dividend investing comes from reinvesting those earned dividends. And it's that fact which is only actually revealed on a long time scale. Dividend investing, and really investing in cash flowing assets in general, is a decades-long game of compounding. And while the impacts of dividends may seem small initially, this snowballs to have massive impacts in future years. So really, you could argue that dividends are the backbone of a long-term investing strategy. For example, here is the returns of the S&P 500 from 1960 to 2023. If you only factored in the price of the index, a $10,000 investment would have grown to $796,000. Now that's still pretty good, but from reinvesting dividends over that entire period, that total value of that $10,000 investment would be $5.1 million. So dividends are not only for retirees. That may be the age in which you choose to start to live off of that dividend income, but the reinvesting of dividends is a core part of your long-term compounding strategy. Even if you're just investing in the S&P 500, which is the most common dollar cost averaging strategy, dividends and reinvesting dividends are a core part of that return. And the longer you can reinvest those dividends and let your assets compound, the better. So dividends, you could argue, are the ultimate long-term strategy. And finally, myth number 3, dividend stocks are just for stability, not growth. If you watch the channel frequently, you know I think that's entirely wrong. On a personal level, I follow a dividend growth investing strategy. So this is in high quality growing companies that consistently raise their dividend payments on an annual basis. Some of these are low yield like Microsoft and Visa, and other are high yield examples like ExxonMobil and Altria. And as you can see, I've gotten high growth in all 4 of those. Even big tech companies like Alphabet, the parent company of Google, are now dividend payers themselves. These are great, high-quality companies that have had fantastic total returns. Over the long run, great, highly profitable companies often pay dividends and share that with shareholders. And if we look historically, dividend growers and initiators have actually had some of the best returns because they have this consistent dividend income being paid out to shareholders. And long-term dividend growth usually means long-term cash flow and earnings growth, which is the core metric that drives stock prices up over time. But another thing these reliable cash flows provide is stability. So if you're investing in dividend stocks or really any strategy, you're bound to hear plenty of other people's opinions online. But ultimately, it is you who's in charge of your own financial future. So you have to stick to a strategy you understand and think is optimal for the long term. And a core part of that is making sure you have the right data to make high quality investing decisions. And that's the entire reason why I built out dividenddata.com. It's a great stock analysis platform for long-term dividend growth investors. It helps you easily identify high-quality dividend growth stocks and then track all of your investments in one place so you can hit that goal of financial freedom. Investing is a long-term game that's core to your financial future. So if a tool like dividenddata.com helps you find just one better stock, then it far more than pays for itself. If you want to join, now is a great time. We have a March Madness sale where you can get 50% off the annual membership for dividenddata.com. You get to lock in that discount price for life. And there's a 30-day money-back guarantee, so no risk in trying it out. Just click the link in the description and pin comment of the video to get direct access to this sale. With that said, thank you for watching this video, and let's get investing.